Alright, so this is going to be a concept that um, I haven't really implemented, but in the conceptual view, I think it's something that isn't seen before. It could be translated onto the higher time frame, and I think has potential for a lot of very good uses that we're unaware of when looking at these higher time frame and determining bias, right? And so that concept is let me see. Let's make it bigger. That concept is higher time frame bias with close variance, right? And so in this context, higher time frame bias, all I mean is that we're going to be using the concept of swing gradients, right? This leads into ideas of dealing ranges, right? Price swings, invalidation levels, right? You also have potential points of entry, validation levels, entry levels, and support and resistance narrative building, right? And so this linked with the close variance on the higher time frame can give us a clustering effect of these swing gradients that will help assist us in identifying these levels when we go to do our weekly and daily day-by-day analysis. And so what exactly is this close variance principle or idea? Well, the idea is that just like there's different openings in the market, there's also different closings in the market. So, for example, just off the top of my head, we have electronic trading hours, which opens at 6 p.m. Eastern Standard Time. We also have regular trading hours, which opens at 9:30 Eastern Standard Time. We also have the concept of session openings, candle openings, true day openings. To simplify, we'll just use true day, which is midnight for New York Eastern Standard Time, right? And so if we have these openings, we also have the closes, right? And so we have electronic trading hours close, which is 16:59. The close of that candle is the close of electronic trading hours. Regular trading hours would be 16:14, the close of that. Now, this is where it's a bit of a gray area. You can use true day, which would be 1500. But then we also have the idea or the option for settlement, right? So we have regular trading hour settlement. Then we also have trading view settlement, right? Or what would you call like platform settlement? So depending on which platform you're operating on, it may have a different settlement than other platforms, right? I haven't fully like gone onto Ninja Traders or different data providers to really see that effect. But all I know is that with TradingView, if you go to the daily chart, we can use settlement as close on daily interval. And we can see that if we use this, toggle this, we'll have a different value plotted than if we were to use the other two electronic trading hours and regular trading hours closes, right? And so there's 3 different anchoring points where you can anchor that closing price. And so hopefully by that demonstration, you can sort of get a glimpse at where I'm going with this, right? And so for example, we'll go to the monthly chart and we'll get the close of October, right? And this is using settlement settlement as close on daily interval. Right, so that was that third option we're talking about. So we'll plot that. We'll turn this off. That will give us electronic trading hours close. And then we'll go to the 15-minute and regular trading hours. Tuesday, October 1st, and give us the close here. And it gives us this close. Right. And now, just so that we are navigating correctly, we can October. We can make a distinction. This was the right. So we have 3 value points for the close. Right. Now the high and the low, those will always be the same because we are dealing with futures. We're not dealing with Forex where every broker is going to have a different value. Futures, it's a lot more efficient in that way. It's regulated and everyone has the same prices no matter where you are in the world, which platform you're trading. You can reasonably expect to have, not expect, you'll have the same prices. Maybe the only one that's a gray area is the settlement close, because not everyone uses TradingView. A large percentage of people do. The third option, or I guess technically the fifth option, would be this 1500 or the 1459 close, which would be this. That's the bond close, right? So if we're to go to Treasury bonds, right at that point right there, that's where the bond closes. Okay. All right. So let me just make all of these uniform. And so now if we're to go to the high of that candle or the low of this candle, let's say that our bias for the month is bearish, right? Let's say that this is going to act as a rejection block or a premium array, right? Market draws up into this wick, attempts to trade to the high, fails, and then we will see the market trade below these lows, right? That's an idea that I have for November, December, the rest of the year, or potentially leading into next year as well. Going down into these levels here. Let's say that that was just a sketch of an idea, right? So what we can do is use the gradient from the previous month's low to anchoring it on these 3 closing variants. All right, so for the first one, we'll change this to the highest. So this would be 20,054.75. Right. And we'll make a distinction. Regular trading hours will be orange. We'll send it to back. Okay, electronic trading hours will be blue. Right, and the settlement close would be gray. Make it gray. The coordinates would be 1.75. Okay. For the idea, it doesn't really make sense to have them color coded differently. I don't really like those colors. Okay, we'll just do it like this. I guess the highest one will always be higher than the last one. Okay, so now that we have that, we can see that there's a natural clustering in the quadrants of the range between previous month's close and the low. All right, and so for or inside the month of November, if the bias is correct in saying that we draw to lower prices, we can work inside of these clusters to frame trade ideas, to frame narrative, to frame a support and resistance idea, to frame invalidation. Right. Those are the type of ideas that we'd want to work with when we're dealing with going from one point to the next, or one PD array to the next. Right. In this case, we'll be trading internal to external range liquidity, but since we're trading on such a large scale, right, or time frame, it gives us a natural clustering effect into which levels that we should use, right? And I want to go to let's go to the previous month and do the same thing, right? Let's say this was a high, and then we'll anchor everything to the close of this candle's or this month's range, right? So settlement, electronic trading hours, and for this we'll just keep the prices on and do ETH, right? This be settlement here, 15-minute, and then we'll get the close. Here. All right. And so anchoring the high to these three closes, we would have a gradient that just slightly differs in its value. Okay. Make sure it's the same. Yep. 24925. And 23325. Okay. But let's say that we're bearish. How come price didn't go up to OTE area or the premium and then sell off to discount? Well, because it needed to draw the liquidity here before making, or I guess one could say that stops need to be blown out before we drove lower. The stops would act as the fuel. The imbalance inside that run up would act as the draw for the market to trade inside of that. All right. To simplify it, on the new month, we can see how the market responds to these levels. All right. So if we have this gradient, this swing high from the previous month, or the last day of the month of September, we created this high. All right, inside of this swing gradient. So at where would the close be? All right, so that's the close. This is the new month opening, right? So yeah, my mistake. This is part of the new month. Everything before this line is part of September's data. This is a new month opening. All right. So our framework could be built around this being your strong high, where we took out liquidity, had an impulse. We attempted to have some retracement here, but this is more of like a lower time frame scale. If you look at a 4-hour, like this impulse is, it's not really that clear on there. Yeah, we have the impulse away from here, we retrace, and then we create an expansion here. But we sort of consolidate near the close of the month. And as we open up on the new month, that's when the market is really active again. And it isn't until it's around 7 a.m. that the market really sees that animation, and then we expand away from this original impulse retracement. All right, we stop out longs, put shorts in the market. Those shorts in the market are naturally being populated above this high in between these two quadrants, right? Into these gradients of quadrants. Stops are put on a protective basis to protect short entries. Those stops are cleared out inside of here. And so all of this is engineering a price move lower once price neutralizes all the stops, and then time lapses where it's free to move, right? And this is likely a news volatility or something. Right? And so you can see how we can sort of build a narrative around the clustering, right? This being more so acting as an equilibrium, this acting as premium, should be strong, and we shouldn't see price drop to here. In the high scale, or ICT calls this encroachment, when encroachment literally means like when something is like trespassing or encroaching. Let me get the real definition, because encroachment meaning. Yeah, it's a violation. It means to enter or force oneself onto another's property or rights. In this case, there's only two parties at play. It's buy side and sell side. And so when we have buy side encroaching on sell side's delivery, right? Because sell side's delivery, it created this impulse away from here, right? You can naturally expect a retracement, but how high can that retracement go before invalidating our idea, right? Well, one of those concepts is the idea of the fair value gap, right? So if we can build a narrative around this area being the strongest point of fair value, where the most amount of pain was placed in on the long side, and then sellers took over and create a displacement, all of these wicks are acting as, like, look how small the bodies are in comparison to the wicks. Right? All of these are like, to me, I see them as like signatures of reversal. All of these gaps, they're acting as, here we have this gap here. Right? This is a shaven bottom or no wick candle, imbalance inside of this, overlapped with whatever these imbalances are, and we break away from that. So one could say that an encroachment is inside of here. Oops. Or inside of these wicks. Right? And so we can draw these out and see the effect. If price reaches up, encroaches on to that liquidity. If price reaches this and trades up and above, then that means that this is no longer going to act as a strong high. This quadrant could be traded to. Right? You see how this lines up with the upper portion of the closed variant swing. I don't know if it sounds kind of weird, but we can sort of like build an idea off of that. Here we have an inversion fair value gap, which is sort of acting on the highs, right? And we can see where price was really encroaching on. It was encroaching on this portion of price action right here, right? Above here, it's pretty much balanced. Then we have a sort of displacement down into this. That's where price drew into, along with the upper portion of that quadrant. You see the second time around, price draws up, right? If you are operating without this information or without some similar idea of this information, then the likelihood of you thinking that this is a short-term rally or a long-term rally is much greater, placing you on the wrong side of the market, right? So there's two pitfalls that traders fall into. It's either we're on the wrong side of the market or we are on the right side of the market, but we're entering at the wrong time. So these two ideas, or this price and time, right? When we get to 6 a.m., we really start to see the animation of this Judas swing, right? Then we create again an impulse retracement expansion after engineering, taking out all the liquidity, putting longs in on a breakout or on a volatility swing up. All right. Think how many traders are looking at this as a market structure break, only to create a false sense of support to then run them out. Right. And so hopefully with that, you can sort of build a narrative. And this lasts for the entire month. We can see how this point of equilibrium acted as resistance once we traded down, created displacement, and then we traded up into the upper portion, right? All the wicks, bodies never violate. Middle portion, we come and trade down, sends it below the lowest. Then we tap it once before selling off, come up, retracement, and then we continue expanding to knock out all this liquidity here. All right, after this reversal, let's say that all of this acted as a equilibrium or a threshold, right? And the market failed to breach that threshold and then traded up higher, all this acting as an equilibrium. And again, going up to premium, this is a candidate or a draw. These are candidates for draws. Same thing with this. And this is if the maximum or the best objective, right? And so we can see how price inverts and reuses these levels for support and resistance, right? Those same ideas. We never violate these candles with bodies. Right? It's always with wicks, and it's always with wicks. Right? Here you can see some discrepancy with the bodies. These trade lower than this. The wicks stay contained within the lower portion. Right. This would be the real equilibrium of that wick on the monthly chart. So once we see price breach through that, there's a strong likelihood that we'll trade through the high. So what this would look simplified on the monthly would just be in equilibrium, like that. Right, and so it just gives a bit more of a spectrum rather than one level. It kind of, I want to say, dismisses the importance, but sometimes we just forget how important these levels actually are from the monthly chart. And so closed variance is just one way to utilize the different closing prices of that month to then arrive at a bit more of a refinement. See, like if we were using the electronic trading hours, we would never have seen this price fail to reach up into here and then sold off, right? And then once we reaccumulate back up in here, this is the target now because it's inefficient, right? There's a gap inside of this. Price trades through that, equal highs. So it's definitely not necessary. It's just something to something interesting they can work with. So this would go all the way up until October, and you can see just how like we're at the equilibrium, and that's like where all the damage was done inside of this, right? So hopefully this has been insightful. Go and use this concept. Even if you don't use it, I think just experimenting with the ideas is something that you can notice things that you haven't before, and it gives a respect to the higher time frames more than before. And in my personal model, the monthly chart and the weekly charts are very, very key important time frames to me. This is one of the ways that I exploit that importance, or I exploit their uses and amplify their importance. Right.